Hello everyone and welcome to this flash market update. Is it a good time to buy US dollar to the Swiss franc? Is it a good time to be bullish on the US dollar to Swiss franc? Well, in one word, I believe yes. But why? What are my reasons to become bullish on this pair, at least for the short term? So let's see in this video what can be the technical perspective for this bullish stance on this pair. Okay. So over here, you can see the US dollar to the Swiss franc. It's the weekly chart. So take note that we're looking at the weekly chart. The first thing that you can see obviously over here is a very classic textbook pattern. So can you guess what this is? This can actually be a possible reverse head and shoulders. So this can be the head and these two can be the shoulder. And over here, you can see that it's possible that this reverse head and shoulder can break to the upside and cause a significant bullish movement to the upside. If this is proven to be a reverse head and shoulder, then the possible projection for the bullish movement to the upside can be at least, so if from here to here is around 900 pips, I believe, then if this neckline is broken, there is an opportunity for the pair to go at least, I believe, 900 pips above this area. So above this neckline, if this is broken, it seems the opportunity to be there for the break for the pair to go at least 900, 800 pips to the upside. So this is the first reason that you can possibly mention as a reason behind the bullish stance for this pair, the US dollar to the franc. And this is the weekly chart. So once more, this is the head, these are the two shoulder, this is the neckline. If you want to be on the safe side, maybe you can wait for the neckline to be broken. And if this break is confirmed, then you can jump in. But personally, I believe this spot right now is an attractive spot to become bullish on the US dollar to Swiss franc, at least for the very short term, even if you don't want to target this neckline and the move above it. At least for the short term, I will be bullish. But what are my other reasons? Let's move on. Okay, so now you can see this is the daily chart for the US dollar to Swiss franc. Over here, there was a bullish advancement starting from here back in September 2018. All the way up till here, till November 2018. If you look at this bullish movement, right around here, you can easily count this as five waves to the upside. So like this will be wave 1, wave 2, a massive wave 3, over here, wave 4, and finally wave 5. So we have a massive 5 waves movement to the upside. Or in better words, an impulsive advancement, an impulsive bullish movement. What happened after a 5-wave advancement was a correction. If you look closely at this move to the downside, the retreat in the prices, you can see that the prices, especially over this area, are very choppy, up, down, up, down, up, down, up, down. These choppy movements are typical of corrections. So usually in trends, you don't have this much choppy movements. Usually in corrections, you have so much overlaps. So this by itself can confirm to us that this move to the downside, so from the high seen in November 2018 till today, which is, I think, January 2019. So all the way from up here to down here, it looks like this is a correction. So this can be another reason to become bullish at exactly this level for this pair. Another reason that you can see over here is the Fibonacci level, the Fibonacci level of 61.8%. This Fibonacci level is the most common level for wave 2s to bottom. So if this is going to be an overall wave 1, so this whole advancement was 5 waves to the upside. If we count the whole wave as a wave number 1, then this correction can be counted as wave number 2. What is the most common area for wave number 2 to bottom or to test and resume the trend, the most common area is 61.8%. So this is another reason that it's a good time to become bullish. So you can put your buy orders around here, and you can put all the stop loss down here. So this will be the area for your stop loss, and this area will be where you can jump in and buy. So first of all, this movement looks like a correction, and second, it's on the 61.8% of the Fibonacci level, which is a good level for wave number 2 to bottom and then resume its advancement, even if this is not wave number 1. And we can phrase it as wave number A. This choppy movement and correction can be wave number B, and following a wave number B, we will have an advancement labeled as wave number C. So either way, either you want to put this as wave number 1 or A, and put this as wave number B or 2, the result will be an advancement as wave number C or 3. So it seems to be a good spot to buy. So this was the daily chart for the US dollar to the Swiss franc. And once more, the low all the way back to September 2018, this area can be your potential stop loss. So you have a limited risk. I think from here to here is about 200 pips. So 200 pips can be your stop loss, and your target can be way above this level. And over here, you see this red line? This red line is exactly the neckline. It's exactly the neckline from the reverse head and shoulder. So if the prices are going all the way up to make a new high, to break this area, at the same time, they will also break the neckline. And if this area is broken, be prepared. Embrace yourself for massive bullishness in the US dollar to the Swiss franc. What will be the reason behind this advance? I am not sure. I don't know. I'm not sure what can be a fundamental reason behind it, and I don't care at all. We're just focusing on technical analysis. What can make the Swiss franc weaken? I don't know. What can make the US dollar gain momentum or strengthen? I don't know. But from a technical perspective, it looks like that the setup is there for the US dollar to Swiss franc to advance. Okay, so let's move on to the next slide. Over here, this is the 4-hour time frame for the US dollar to Swiss franc. What I want to point out in this slide is what we call a convergence. That is correct. A convergence. So over here, you have a low. This is the corresponding MACD. And over here, just today, 9th of January 2018. Now it's 5 p.m. Eastern time. Just about an hour or maybe 30 minutes ago, the pair made new lows over here. And if you look at the corresponding MACD bottom, you see that the corresponding MACD bottom for today's low is higher than the bottom for the other MACD from this low. So this low and its corresponding MACD bottom, when you compare it to this low with its corresponding bottom, you see that the lower low, which is this one, this is the lower low, also has a higher bottom. So we have, if you connect the lines from here to here, if it works, so from here to here, and then from here to over here, you can see the convergence. So you have convergence in the 4-hour chart. So this is another reason to become bullish. And because this is the 4-hour chart, you can say this will be a reason to become bullish, at least for the very short term, maybe for till end of this week at least. So for the short term, the trade setup to become bullish is there for the short term. Also for the long term, the setup to become bullish is also there. So long term and short term both are pointing to a bullish opportunity. So what can we do here? We can start buying over here, and after it reaches our target for the short term, we can close some of the trades in profit and leave some of them for the longer term if we want to, which will target way above the broken trend line, broken neckline. So this neckline, but maybe we can move on to the daily chart. So over here, this was the neckline. If this neckline is broken, we can continue with our longer term on at least to 900, 800 pips above this level. But for the short term, you can come out sooner, but where? I will explain later on. So over here, one more time, this is the 4-hour chart. And there's a divergence, which is a bullish signal for this pair. So both long term and short term say bullish. You will buy from around here. When it reaches your short-term target, you can close all trades or most of the trades and leave some of them open for the long-term stance. Okay, let's move on. So over here, the only threat to our bullish stance is seen on the weekly chart. So over here, you're looking at the weekly chart for the US dollar to Swiss franc. If you look closely one more time, you can see the moving averages over here. Both the 100 moving average, 100 weekly moving average, and the 200 weekly moving average, both are broken in this week. So this week, the US dollar weakness so far has broken both the 100 weekly and 200 weekly moving averages. And this can be a huge, actually, selling sign or bearish sign. But this is only one reason to the bearish side, and it will not be enough for selling a pair. And more importantly, this break can be a false break. So I believe this will be the case. So this candle, this weekly candle that you can see, we have Thursday and Friday. Probably Thursday and Friday, this candle will go all the way up and make a close above the moving average. So if you put this 100 and 200 weekly moving averages on your own charts, or you can see the price target over here, I believe that probably by end of the week, this candle will ultimately close above these moving averages. So these moving averages, the candle currently is like this, all white to the downside. But I believe at the end of the week, it will probably look like this, and it will close above the moving averages. And if this happens, this will be a false break. And if this false break happens over here, it can actually be a significant bullish sign. Currently, the break of the 100 and 200 moving averages, the 100 and 200 weekly moving averages is broken in this picture as of right now that we are speaking. So currently, this has the potential to be a bearish signal. But you can only find out after the week close. So if the weekly close for this pair and this candle, so pay a close attention to the weekly close for this candle. And if the close is below, it's still below the moving averages, then maybe you can consider coming out of the trade, or not at least buying for the long term. So the way that I will do this is at current levels, I will buy. I will put a stop loss over here, the lows in September 2018. For the very minimum and short term, I will have a bullish stance for at least 80 to 100 pips. So I will buy right now at this very moment, and I will wait 80 to 100 pips for the pair to go up. If it goes up, I will close main bulk of my trades. I will leave a few of them open. So if, for example, I have 10 trades buying this pair, if the pair goes up about 80 pips from now, I will close about 8 or 7 trades. And I will leave 2 to 3 trades open for the longer term. But for these two, for this part, 2 to 3 trades, I will also look at the weekly close for the pair. If the weekly close is below the moving averages, the 100 and 200 moving averages, I will also close these trades. So right now I will put a buy for the US dollar to Swiss franc, and I will wait 80 to 100 pips for it to go up. If this happens, I will close 8 to 7 trades and I will take my profit. The remaining 2 to 3 trades, I will wait till the weekly close. So I will open it, but wait till the weekly close. If the weekly close is still below this broken 200, 100 moving averages, then I will get out. But if it comes back and it closes above this level, then I will remain bullish on this pair. Even I will add more trades to it. Either case, for the short term or the long term, the stop loss will always be set at this level. So look at the lows around September 2018. Find the low around September 2018. This will be your stop loss, whether for the short-term trades, whether for the long-term trades. Okay, so I'm pretty confident that the short term, at least we will have the 80 to 100 pips advancement. So I'm pretty sure we can catch this profit. But about the long term, in order to be safe, I will wait for the weekly close. If the weekly close is below this broken moving averages, I will get out. But if the weekly close comes all the way back and goes above here, so if the weekly close goes all the way back and goes above this place, I will become bullish, or I will remain bullish, even add more trades. Okay, great. So let's move on. So this is the 1 hour chart. This is the hourly chart for the US dollar to Swiss franc. For the very short term, if I am going to have a target, it will be these moving averages. So if you put buys over here, till this 1 hour moving average is about 80 to 100 pips. So testing the hourly moving average will be my target for the short term buy. So one more time, I am buying at this area right now. Today is 9th of January 2019. It's 5 p.m. Eastern time. I'm putting buy orders at this area. The take profit for 8 trades, 7 to, so I'm opening around 10 trades. For 7 to 8 trades, the take profit will be 80 to 100 pips higher. So the take profit for the very short term will be around this area, okay? But for the longer term, I will have 2 to 3 trades open, and I will monitor the weekly close for the pair. If the weekly close is below the moving averages, that is broken right now, the 100 weekly and 200 weekly moving averages are broken. If the prices close below this 2 moving averages, then I will cut my long-term bullish stance. But if it proves to go up and close above the 100 and 200 weekly moving averages, then I will stay on my bullish stance, and not only stay on the bullish stance, but add more trades to it. So the most important part for the short-term buy is a definite, no question. I will get this, and I'm pretty sure I will get the profit. But for the longer term, in order to keep it open, I will closely monitor the weekly close for US dollar to the Swiss franc. So at least you can target the short term. Where's the stop loss? One more time, the stop loss is the low back in September 2018. This will be the stop loss. The advancement to the upside is expected to be either wave 3 or wave C. Okay, so great. That's all for this video. So this was a very flash and rapid market update on the pair US dollar to the Swiss franc. Good luck with your trading. I hope you have enjoyed this video.